You know that moment when you log into your investment account and the total balance finally shows 7 figures for the first time? Not 6 figures with some encouraging progress towards 7, but actual $1 million or more staring back at you from the screen. There's this strange mix of emotions that hits. Pride, certainly, because you worked incredibly hard to get here, but also this quiet anxiety because suddenly you have something substantial that could be lost. Maybe you've spent years being disciplined, living below your means, investing consistently, making smart choices, and now you're wondering if the rules change once you cross this threshold. Perhaps you're concerned that one bad decision, one lawsuit, one market crash, or one wrong move could erase years of careful accumulation in ways that feel completely outside your control. Here's what most financial advice won't acknowledge about reaching your first million. The biggest threat to your wealth isn't market crashes, inflation, or economic recessions. The biggest threat is actually the psychological shift that happens when you see that 7 figure number and start making decisions based on how you feel rather than what makes mathematical sense. Understanding how to protect wealth, not just build it, requires a completely different mindset than what got you here. My name is Anderson, and I help people understand that accumulating wealth and preserving wealth are two entirely different disciplines requiring different strategies. If you've reached or are approaching your first million and want to understand how to protect what you've worked so hard to build, stay with me through this. Subscribe if this kind of practical wealth preservation perspective helps you navigate these new challenges. Now, when you think about protecting wealth, what comes to mind? Do you picture complex offshore structures, elaborate tax schemes, or strategies only available to the ultra-wealthy? Or do you assume that since you've successfully built wealth, protecting it will be straightforward using the same approaches that got you here? Here's the contrarian insight that's going to change how you think about wealth preservation. The skills that got you to $1 million are foundational, but protecting and growing that wealth requires a completely different playbook. It's like believing that training for your first marathon qualifies you to compete at the Olympic level. The fundamentals matter, but the game changes entirely at different levels. The statistics about what happens to people who suddenly acquire wealth are genuinely sobering. Whether through inheritance, business sales, or other windfalls, a significant percentage of people who come into substantial money end up losing it within several years. The reasons vary, but they almost always trace back to lacking proper wealth protection strategies. What exactly does wealth protection look like when you're dealing with your first million? It's not just about selecting the right investments or implementing strategies you see dramatized in entertainment. Real wealth protection involves creating multiple layers of defense against various threats that could erode your financial position over time. The first rule, and probably the most important one that people completely overlook, is building a professional team. And I don't mean asking your friend who did well with some stock for advice. I'm discussing assembling qualified professionals who specialize in working with millionaires. Here's a statistic worth noting. 69% of millionaires work with financial advisors, compared with just 33% of the general population. Think about the mathematics here. When you had $50,000 to invest, making an error might cost you a few $1,000s. When you have $1 million, that same percentage mistake could cost you tens of thousands of dollars. The stakes are simply higher, and the complexity of managing larger amounts increases substantially. A quality financial advisor doesn't just help you select investments, they help you identify opportunities and blind spots you might miss independently. They provide accountability during market volatility and help ensure that emotional decisions don't derail your wealth preservation strategy. Most importantly, they help develop a comprehensive plan customized for your specific situation and long-term objectives. But here's where things become interesting, and this separates people who build lasting wealth from those who temporarily possess money. The number one concern millionaires have isn't about generating more money, it's about taxes. According to recent research, the primary question most millionaires have about their financial future is how taxation will impact them. This makes perfect sense mathematically. Once you reach the $1 million mark, you're likely in higher tax brackets than you've ever experienced. Your investment gains face capital gains taxes, your dividends get taxed, and if you're still working with high income, you might be facing marginal federal tax rates of 37% or higher, potentially much more when you include state taxes. In some states, high earners face total tax burdens exceeding 50% when combining federal rates, state income taxes, and additional levies. Without proactive tax planning, you risk surrendering a massive portion of your wealth unnecessarily. This is the second rule. Tax optimization becomes absolutely crucial for wealth preservation. It's not about illegally avoiding taxes or implementing questionable schemes. It's about understanding tax code sufficiently to minimize liability through legitimate strategies wealthy people have used for generations. Some strategies are relatively straightforward. Tax loss harvesting involves selling investments that have declined in value to offset capital gains from other investments. Municipal bond investments can provide tax-free income for high earners. Charitable remainder trusts allow you to support causes you value while receiving tax benefits and income streams. Other strategies are more sophisticated but incredibly powerful. The backdoor Roth IRA allows high earners to access Roth benefits even when income exceeds direct contribution limits. The mega backdoor Roth uses after-tax contributions to employer retirement plans to achieve significant tax-free growth over time. But here's what's genuinely fascinating about tax planning at the millionaire level. The current environment presents both unique opportunities and potential risks that could dramatically impact your wealth preservation strategy. The lifetime estate tax exemption for 2025 approaches $14 million for individuals and nearly $28 million for married couples. This represents a massive opportunity to transfer wealth tax-free, but this window might be closing. Uncertainty around future tax legislation means wealthy individuals need to be proactive about utilizing current tax benefits while they're still available. Waiting to implement tax strategies could literally cost hundreds of thousands of dollars if rates increase or exemptions decrease in coming years. This brings us to the third rule that most people don't consider until it's too late: asset protection. And this is where things become genuinely concerning if you're not prepared. The moment you become a millionaire, you essentially become a target. Not necessarily for criminals, though that's a consideration, but for attorneys, creditors, and anyone who might view your wealth as an opportunity to solve their own financial problems. Here's something that will probably concern you once you fully understand it. In our increasingly litigious society, anyone can sue anyone for practically anything. That minor traffic incident that used to be an inconvenience could suddenly become a $1 million lawsuit if someone discovers you have assets worth pursuing. It doesn't matter if you're extraordinarily careful and responsible. All it takes is one accident, one misunderstanding, or one person who decides you're their path to financial security. This is why wealthy people become focused on asset protection, and it extends far beyond just having quality insurance, though insurance absolutely represents the foundation. When you have $1 million in net worth, your umbrella insurance should match that entire amount. Most umbrella policies are sold in increments of $1 million up to $5 million. And frankly, if you're worth $1 million and you don't have umbrella insurance, you're gambling with your entire financial future. But insurance is just the beginning. Sophisticated asset protection involves creating legal barriers between you personally and your wealth. This is where structures like limited liability companies and family limited partnerships become relevant. These aren't just elaborate schemes wealthy people use to feel important. They're legitimate legal tools that can protect assets from creditors and lawsuits. Think about it this way. If all your wealth sits in accounts under your personal name and someone successfully sues you, they can potentially access everything you own. But if your assets are properly structured within protective entities, even if someone wins a judgment against you personally, they might not be able to touch wealth held within those structures. The difference between having no wealth and having $1 million is much more significant from a legal perspective than the difference between having $1 million and $10 million. Once you cross that threshold, you become what attorneys call a worthwhile target. The goal isn't to become completely judgment proof, which is probably impossible. The goal is to make pursuing your assets so complicated and expensive that most potential litigants will reconsider before coming after you. The fourth rule involves something that's arguably even more important for protecting your first million: investment diversification and portfolio management. This is where many newly minted millionaires make mistakes, costing them hundreds of thousands of dollars over time. Here's what typically happens. Someone builds their first million through a combination of employment savings, perhaps real estate appreciation, and probably substantial stock market gains. They examine their portfolio and see that whatever performed well during their wealth building phase made up a large part of their success. So they think, why change what's working? The research on millionaire investment behavior is actually surprising. Self-made millionaires typically structure portfolios with a simple formula that might seem boring to people accustomed to chasing trending investments: 80% global stocks and 20% bonds. That's it. No complex trading strategies, no attempts to time markets, no concentration in whatever sector happened to perform well recently. This approach might seem unexciting, but it reflects a disciplined mindset prioritizing wealth preservation over wealth accumulation. When you're building your first million, you can afford bigger risks because you have time to recover from mistakes. When you're protecting your first million, the calculation changes completely. Diversification functions because different asset classes tend to perform differently under identical market conditions. When stocks are declining, bonds might be holding steady or even gaining value. When inflation erodes fixed income returns, real assets like real estate and commodities might be appreciating. The objective isn't maximizing returns in any given year. The objective is minimizing the chance that any single market event could devastate your wealth. Here's a practical example illustrating why this matters. During the 2008 financial crisis, portfolios heavily concentrated in stocks lost 40% or more of their value. Some people watched their million-dollar net worth drop to $600,000 practically overnight, but diversified portfolios that included bonds, international stocks, and other asset classes experienced much smaller declines and recovered much faster. The mathematical reality is that losing 40% of your wealth means you need to gain 67% just to return to where you started. If you have $1 million and lose 40%, you're left with $600,000. To get back to $1 million, that $600,000 needs to grow by $400,000, which is 67% of the remaining balance. This is why millionaires become focused on avoiding large losses rather than chasing large gains. A 20% gain is valuable, but a 20% loss requires a 25% gain just to break even. The mathematics of wealth preservation differ completely from the mathematics of wealth accumulation. Let me introduce you to someone I'll call Patricia, because her experience illustrates these principles clearly. Patricia reached $1 million in net worth at age 43 through disciplined saving and smart career moves. She felt accomplished and decided that reaching seven figures meant she'd earned the right to take more investment risks. She concentrated 60% of her portfolio in technology stocks because they'd performed exceptionally well during her accumulation phase. For 2 years, this strategy worked brilliantly. Her net worth grew to $1.3 million. Then the market corrected. Technology stocks declined 45%. Patricia's concentrated position meant her portfolio dropped to $800,000. It took Patricia 4 years to recover to $1 million and another 3 years to reach $1.3 million again, 7 years to get back to where she'd been. Meanwhile, her friend Daniel maintained a diversified portfolio of 80% stocks and 20% bonds. When the market corrected, his portfolio declined only 23%. He recovered to previous levels within 18 months and continued growing from there. The difference wasn't intelligence or market knowledge. The difference was understanding that wealth preservation requires different strategies than wealth accumulation. Patricia learned this expensive lesson and restructured her portfolio accordingly. She's now focused on steady, sustainable growth rather than trying to maximize short-term gains. The fifth rule becomes absolutely critical once you reach millionaire status, but most people postpone until too late: estate planning. I understand estate planning sounds approximately as exciting as watching paint dry, but this is where things become genuinely important for your financial survival and legacy. Here's the uncomfortable reality nobody wants to discuss. The moment you become a millionaire, the government becomes very interested in what happens to your money when you die. Currently, you can pass approximately $14 million to heirs without triggering federal estate taxes, which sounds like substantial breathing room when you've just reached your first million. But here's what most people don't recognize: that exemption amount isn't permanent. Tax laws change, and they usually don't change favorably for wealthy people. The current high exemption levels are scheduled to expire, and there's ongoing political pressure to reduce them significantly. What feels like comfortable buffer today could become a serious problem if you don't plan properly. Plus, if you're successful at growing your wealth over the next 20 or 30 years, you might find yourself in territory where estate taxes become a genuine concern much sooner than expected. But estate planning isn't just about taxes. It's about ensuring your wealth actually ends up where you want it, rather than getting tied up in legal battles, consumed by probate costs, or distributed according to state laws that probably don't match your wishes. Without proper estate planning, your $1 million could easily become $600,000 by the time it reaches your intended beneficiaries. That's not exactly the legacy most people envision. The foundation of estate planning starts with having current legal documents: a will, obviously, but also powers of attorney for both financial and healthcare decisions. When you're dealing with substantial wealth, trusts become incredibly valuable tools, not just for tax planning, but for controlling how and when your wealth gets distributed. A revocable trust can help your assets avoid the public probate process, which means your financial affairs stay private instead of becoming public records anyone can access. Strategic gifting is particularly relevant currently. You can gift $18,000 per person annually without triggering any gift tax consequences. That might not sound substantial, but it accumulates quickly if you have multiple family members. A married couple with 2 adult children and 4 grandchildren could transfer over $200,000 annually without any tax implications. Over 10 or 20 years, that represents serious wealth transfer. So there you have it, your framework for protecting your first million from every conceivable threat, including your own excitement about having 7 figures. Professional guidance, tax optimization, asset protection, diversified investing, and estate planning. The 5 rules that separate people who build generational wealth from those who temporarily possess substantial money. The choice is yours, but your future self is definitely hoping you'll make the strategic decisions that preserve what you've worked so hard to build. Reaching $1 million is an achievement. Protecting it and growing it from there is what determines whether you've built something lasting or just reached a milestone you couldn't maintain.